Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Torsten Slok of Apollo writing, a trade war is a stagflation shock. Torsten Slok joins us now for more. Torsten, good morning.
Morning.
Is firing the Fed chair a stagflation shock?
So a stagflation shock is by definition that inflation will go up and GDP growth will go down. But if you fire the Fed chair, as we saw yesterday, the dollar will likely go down. And at the same time, long rates will be going up. And the dollar going down is certainly inflationary. But rates going up is, of course, holding back growth. So firing the Fed chair will probably mainly mean a decline in the dollar and an increase in long rates.
Let's talk about the stag versus deflation. Do you expect to see that inflation for very long?
Well, so far there's a number of FOMC members, when they talk about this, that they discuss what is the persistence of the stagflation shock. In other words, when tariffs start to be more visible in the data. And I absolutely believe the data we just got this week, it is the case that we're now seeing lift off in inflation in goods, because we are seeing goods inflation, which makes up 40% of the CPI basket, seeing on a number of different categories, tools, toys, apparel, furniture. We've seen a fairly decent rise. And if we begin to see that lift off now over the next several months, then the risk is, of course, that this becomes more persistent. And Beth Hammack from the Cleveland Fed has said that in her district, companies that are exposed to tariffs have been raising prices, but even companies that are not exposed to tariffs have, for competitive reasons, also been raising prices because, hey, if others are doing it, we can also do it. So the fear at the Fed is that this does become more persistent and more sticky. So that's why it's so difficult for the Fed to go out and declare victory and say, oh, this is just temporary. They need to wait to see the peak. And we are really only at the takeoff stage. So we have not seen the peak. The consensus expects that later this year, by probably November or December. But the bottom line is, before we can see that peak in sight, it is not clear that the Fed will say that now we're going to cut rates more meaningfully.
How do we explain what's happening with services prices?
Well, so of course, when something has a weight of 40%, and we know very well that that's now going up, of course, the issue is, well, what about the 60%? Is that also going up? The 60% consists to a large degree also of wages. And what we know from deportations, of course, at a run rate of around 1 million people in 2025, that means that wage inflation will likely begin to go up in the areas where unauthorized immigrants are working, for example, in agriculture, construction, leisure and hospitality. So the fear you can have is that it's not only goods inflation coming from tariffs, it's also the upside risk to services inflation coming from wages, especially because of deportations potentially beginning to play a more significant role.
Torsten, is the consumer able to absorb this?
Well, on the retail sales data today, it's quite interesting because the low-end consumer has been in trouble for quite some time because we've seen auto loan delinquencies go up, we've seen credit card delinquencies go up. That's mainly because lower-income households generally have more debt, they generally have lower FICO scores, and when you have more debt and the Fed raised rates in 2022, that means that low-income households are having higher debt interest payments. So therefore, low-income households have been in trouble for some time. Now, high-income households have been in good shape because stock markets are up, home prices are up. If you own fixed income, the cash flow you get from private credit, public credit, that's been very, very strong. But the middle income households are now facing the new shock that student loan payments restarted after the moratorium or the pause on paying back your student loan ended here in May. So that means that the rating bureaus are now being told if I'm not paying my student loan. And that means that we are, unfortunately for the consumer outlook and therefore for retail sales here at 8:30, seeing the risk that it's not only low-income consumers that are now facing headwinds, it's also the middle income consumers. And there's about 11 million people who are not paying their student loan on time at the moment out of 45 million people who have a student loan. So that means with a 25% delinquency rate on student loans, this is at risk of implying that credit scores are going to go down. According to the New York Fed Liberty Street blog post, it could be as much as 75 points on your FICO scale. So people who have a credit score of 725 goes down to 650. That means that middle-income households are at risk of seeing not an ability to borrow, to buy a car, a house, washer, dryer, iPhone. So therefore, the risk to consumption is that it's going to broaden out the headwinds, not only to low end, but also to middle. middle income.
When you look at tariffs as a headwind, if the president is about to potentially settle on 10 to 15% across the board for 150 countries while he's in active negotiations with some of the biggest trading partners, is that enough for the Fed to then start to model out what that could mean and cut rates? What's the timeline between getting the final tariff rates and the Fed being willing to cut?
Yeah, that is really important because excuse my picture, a pig is coming through the python here in terms of tariffs and what it means. Are companies going to raise prices for consumers, and that's the way we pay for tariffs, or are companies going to take it in earnings? So there are various simulations from the Yale Budget Lab, the Penn Wharton Budget Model, the Tax Foundation, which try to look at what are the implications of different levels of the effective average tariff rate. And those show indeed that it does take time, so the Fed will not have clarity on this issue, maybe not even this year, which is exactly why FOMC members are so reluctant to come up with answers. How do we even quantify what the impact is? And the final point in your world is, of course, also, what about the hearings for the IEPA on July 31st? That's now several weeks away. Will that all deem that there is a risk that this could all turn out to be not legal? What does that then mean for the August 1 deadline? So in the near term, the Fed is certainly going into the July meeting, in my view, thinking we cannot just even signal that there is any rate cuts coming because we just don't know yet the persistence, the magnitude, and therefore overall what are the implications of tariffs at this point.
Can I just deal with that word we? How many people make up that word we? And how many people put their hand up and say, you know what, actually we should cut, and we should cut this month?
Yeah, of course, both Chris Waller and Mickey Bowman have been turning more towards talking about cuts potentially being something that should be likely. But the answer is to your question, at least the vast majority of committee at this point is certainly, at least in the reading, if you look at the dot plot, weighing towards saying, well, there is probably a good argument for waiting.
Median dot still projects, implies 2 cuts. Morgan Stanley, no cuts. Bank of America, no cuts for 2025. What's your base case? Given what we know now, what's your base case?
We have 1 cut in December. But I do think that the market is way too eager to price in cuts. Again, the risks are, and not only we talk about tariffs as upward pressure on inflation, we also talk about immigration restrictions and deportations as upward pressure on inflation. But let's also not forget that if you take FERPAS, the Fed's model of the U.S. economy, and you ask the question, what does the Fed itself think is the implication of a 10% depreciation in the trade-weighted dollar? And the answer out of FERPAS is that inflation will go up over the next 4 quarters by 0.3. So now we suddenly don't only have the uncertainty about tariffs putting upward pressure on inflation, we also have immigration restrictions putting upward pressure on inflation. And then we also have that the depreciating dollar for the last 6 months is also putting upward pressure on inflation. So all that argues for rates higher for longer. And on top of that, in the long end, we also have fiscal issues putting upward pressure on inflation. So the whole yield curve is likely to stay elevated for a much more extended period than what the market is appreciating at the moment.
The Federal Reserve is projecting transitory. It's just implied by the forecast. Core PCE for 25, 3.1, 26, 2.4, then down to 2.1 in 27. That's the glide path. Do you project transitory?
Well, that is also, if I type ECFC, go on Bloomberg, I see exactly that profile where inflation will peak at 3.3 by Q4 of this year, and then it will begin to come down. But noteworthy is it, including in the Fed forecast, that we will only by the end of next year have inflation still at 2.5. That's still way above the Fed's 2% target. So you could begin to argue, if you begin to cut rates when inflation is 2.89, or if we get basically a situation where inflation turns out to be more sticky, the risk is, of course, that they will be cutting prematurely. And that's what literally every FOMC member worries about, namely, did we cut too quickly? And are we therefore then creating more boom in the economy, including with the one big beautiful bill lifting GDP next year? We could have a fairly strong economy going into 2026. And with that backdrop, it becomes very difficult to argue that you should see a lot of Fed cuts next year.
Do you think the 100 basis points of cuts in the run-up to the election was premature?
Well, of course, at this point, we had no longer talk about our star as we have done now for a long time. And this was the strong argument at the time that monetary policy was restrictive. They even still in the footnotes of FOMC member speeches talks about, well, monetary policy is still today restrictive. But if you look at it that way, well, if monetary policy is so restrictive, why is the economic data then still doing so well? So that suggests that maybe this whole discussion has, interestingly enough, completely faded into the backseat of the car. We're no longer talking about our star and restrictive. Now we're so eager instead to talk about the inflationary impulse coming from, in particular, tariffs, but also the dollar going down. So I think that the debate around why are we at these levels of interest rates and where should we be, that debate seems to be almost yesterday's debate. So that's why I think a lot of the impulse and the discussions on the FOMC now is all about what's coming ahead of us. And what we know is coming ahead of us is exactly what the forecast from the Fed is saying, namely higher inflation. Jay Powell said himself, we expect a meaningful increase in inflation over the coming months. That's a very strong statement. statement from the Fed chair. So I think that we should, in markets, take that very seriously when the Fed chair is staking a lot of credibility on saying we expect a meaningful increase in inflation over the coming months.
Torsten, it's good to see you. As always, thank you, sir. Torsten Slok there of Apollo. DeMare of Bank of America writing, volatility has whipsawed global markets. That's been good for the markets businesses at Bank of America. Jim joins us now for more. Jim, good morning.
Good morning.
It's good to see you.
Great to see you.
It's great to catch up. Masses of volatility.
Yes.
You can have the good kind and the bad kind. Why was this the good kind?
We like to think about everything in terms of channels. When there are channels of price action, channels of volatility, those tend to be better opportunities for investors to put money to work. If we were sitting here 10 years ago, the bigger conversation was financial repression, right? And if you look at realized volatility in both the equity markets and in the rates markets, let's focus on the U.S., realized volatility is considerably higher than where we were then. And you see a lot of investors, macro strategies are becoming much more popular today than they were 10 years ago when it was just difficult with suppressed volatility to deliver alpha. And so I think, volatility's here. We're in a different, political and economic environment than we were 10 years ago. So my suggestion would be get used to a higher degree of volatility.
You think this is an ongoing feature of this regime?
I think just where we are in the economic cycle, things are just very different, right? We're going to have there's increased spending happening in infrastructure, in technology, in defense. We've got high levels of debt in the developed world that becomes, more topical depending on what other actions are taking place or headlines are hitting during a given day. A lot of focus on Japan, for the last month and a half. In April, we were talking more about the U.S. markets and concerns about, a failed Treasury auction, which I think was extreme, to say the least. But, in the end, some of these larger structural issues remain. And I think we'll go through periods of, yes, there's obviously concern about, Fed independence and what could happen there. And I think you've had pretty much everybody on the show talk about it for the last 24 hours.
Please, give us your opinion.
The last 24 hours, Fed independence is good. I'll leave it at that.
If it starts to be threatened, what does it mean?
I think people are going to wait to see what happens. I don't think anybody's going to is going to exit the markets on concerns that is a certainty. I think with many things that have transpired over the last 90 days, there's a test period. Theories are tested in the markets respond. That information is filtered back into the decisioning process, and we're going to continue. We're going to continue on that path. But I do think, when you think about the sovereign debt levels in developed economies across the globe, that is a real concern. It's going to keep popping its head up or rearing its head until there's some resolution. There was a lot more talk about it until the bill was passed. Now it's again a focus on Japan, and I'm sure there'll be talks about other countries in Western Europe and in the UK as we continue on that path. So. I think betting against volatility is not a good strategy for the near and midterm.
When it comes to volatility right now, what makes this environment potentially different, or I guess you can mirror it to Trump 1.0, is it's politics and policy that is driving this in financial markets. Yes.
And again, I think that's why it's a materially different environment than we had, post the financial crisis up through COVID. While we had different administrations, the policy path was still pretty consistent regardless of Democratic or Republican administrations, and the Fed policy was very consistent, and it was QE for a large part of it, and that was a repression in volatility, and that environment is no longer here.
What's the number one question clients ask you?
Wow, that's a really great question. I think the biggest focus remains on whether we're getting cuts this year, or not. And there's some pretty strong views on either side. And that's really a bigger question on what do we think inflation looks like? Is it transitory, or is it going to remain at a higher elevated rate. I would say the second largest question, if you get out of the bond markets for a second, is the AI investment period that we're in today. Is it a bubble? Is it a high correlation to what we saw, in the late 90s going into 2000? And, there's stories written on that every day. I think what's very clear is that the investment is going to continue for the near to medium term, whether it's a result of corporations or sovereign governments being focused on AI being critical to economic growth and safety. And so you see that all around the world, governments are making it one of their top mandates to be a leader in AI.
It's driving equity markets in a massive way.
Yes.
Basically at all-time high still.
Yes.
On the S&P 500, very close. And credit spreads are super tight.
Yeah.
High yield spreads are very, very tight. Do you see that as justified or a sign of complacency? There is a man at another bank who believes that maybe it's a sign of complacency. Don't have to name him today. I want your opinion on that.
Yeah, I mean, we go through periods of, when the market's down, nobody wants to buy it and everybody gives 15 reasons why it's going to go lower, and it goes up, and then people give you reasons why it's not going to go, it's not going to go any higher. I think the markets in general and people were, as humans, we have a certain degree of fear in us, and we're worried about what could happen and what could be life-threatening, and that's just human psychology. And post the financial crisis, we look at it and say, okay, what are we missing? I think a lot of what the issues are that could result in a repricing in assets across the markets, they're all out there. The question is, are the markets reflecting that in their current price? To me, that's really the question that you always have. And, the debate is today, you could sit with people today and they'll tell you that, the real level of rates in the U.S. market in the long end is too high, based on what their expectations are. The converse of that is people saying that we're concerned about long-term debt because of structural budget deficits. Flip it over to the equity markets. There's many people that are excited in saying AI is real. It's going to drive productivity. We're going to see a boost in earnings across industries and across sectors. And then there are others that say, well, this is just another bubble, and we've seen this play through. It's a good opportunity for us. We have a lot of clients that are thinking about things differently, and obviously, our strength is intermediating risk, lending to them as they pursue these opportunities, and that's what we're focused on.
What I sense from you is that now there is a bias to act. In early April, it felt like a lot of people were just paralyzed by the backdrop.
Yes.
Where's the bias to act coming from? Are they just moving on from this policy story in Washington, or have they got the clarity they want, or at least enough clarity to just move on?
I think that's a really great question, and I think it's difficult to answer, but I would answer it this way. You start with framing what are the extremes that could happen, and then getting comfort within that. And I think at the time when the tariffs were announced, the concerns were how, this could be a material negative impact on global GDP. Okay, and that was reverberating. And at the same time, we just happened to have treasury auctions, within a week's time. And then so you had this period of disruption in the equity markets, uncertainty. You get to the bond markets, we're having large auctions. Someone starts to focus on, and it proliferated in the market, what the participation rate was of foreign investors in the 3-year note, which, if you go back and look at the numbers, yes, that was a high single-digit participation at the time, but that's not the first time it's been a high single-digit participation relative to participation, in double digits. But, if you wanted to find negative dots to connect to come up with a very negative story, we provide, the markets provided it.
So a few months ago, 20-year auction.
Yes.
Nobody in fixed income cares about the 20-year treasury. Nobody. And then all of a sudden you have a soft 20-year, and all of a sudden that's a reason to sell everything.
Yes. So to that point, I think that framing and then bringing it in, and as some of those outliers or the extremes of those risks are framed narrower and narrower, that's when you get you get positive sentiment.
When you talk about those extremes, do you also think that the president has set red lines, what he's willing and not willing to do? This idea of a Trump put. Do you think investors have taken that on board?
I think that he's a very smart man, and he's very connected to what's happening in the markets. I don't think that that's the only driver of his decisions, clearly based on what the statements have come from him in the administration. But that being said, we are one of the most powerful economies in the world, and you need to be cognizant of that. But I do think that there's, if you're being objective and independent, you can frame things, I think, and get to a point where you know where the extremes could be, and those extremes have been coming in. And I think that's giving people more comfort to make some of these decisions. I mean, sector trends that are happening in equities, the investments happening, it's happening with people that have the capital to make the investments. It's clear that the need is there. Now, whether it's going to result in the productivity or cost saves, that's going to take, more 2, 3, 4 years to see that. So I think for that sector, but then you have it in energy investment that's happening, defense, which is, globally that's becoming a thing. So I think if you look at those sectors in the equity markets, people feel comfortable that there are strong fundamentals and technicals, and it gives them the kind of strength and optimism to carry on. I think the bond markets are going to keep the volatility up, and Brian mentioned it, yesterday. We went through a historical period of low front-end rates that was unprecedented, and I don't think those times are coming back. I think there are people that run certain investment strategies and certain people in the real economy that would really like zero interest rates, and I think that's why you're seeing some of the correction continue in the real estate market, just because interest rates are normalizing higher, and we're going to continue to see, challenges for those industries. And I'm not, highlighting just the real estate industry. If you were a highly levered company and you were used to borrowing short term, that's no longer a viable strategy.
Can we finish at the long end of the curve?
Yes.
Is the character of developed markets, sovereign debt markets, beginning to change? Typically, by definition, when bad things happened in DM, you bought the bonds.
Yes.
You bought treasuries.
Yes.
It just feels like that story's starting to turn. And we have these moments of stress where we see equities and bonds trade in tandem together.
Yes.
It's not just the US, we see it in Europe, we're seeing it in other countries too. What's happening and how are investors changing?
Well, I think you hit it, and that was one of the big concerns, for smart investors that saw that price action, stocks down, bonds down. That's not a good sign for health of the markets from a historical perspective. And with that being said, and with the concerns about the deficit, I still think, the markets are telling me, I think that there's still optimism that there's going to be, a better deficit environment on a go-forward basis. If you think about it, meaning maybe we're going to get growth that's higher than that's projected, and perhaps the structural deficit that we have won't remain as large as what's been feared. If you think about it, the bill was passed, the information's now clearly out there. This is what everybody was worried about, and there hasn't been a significant sell-off. I'm not saying that there hasn't been 10, 15 basis point moves, but people are talking about a 6% long bond as a given, not as a possibility, just months ago. So I do think that the calmer heads are prevailing, and people just want to see this data flow through the system and see this policy flow through the system.
Let's hope it stays that way. Let's do it again soon.
Yes, great. Great to see you. Thanks
Thank you, sir. Jim DeMare there of Bank of America. We've seen the reports, we've heard the denials. Let's get into it with the former St. Louis Fed President Jim Bullard. Jim, welcome back to this program, sir. I want to get to monetary policy and economics before we get to the politics of it all. Do you think there is a credible argument for lower interest rates at this month's meeting?
I do think that the Fed could resume its normalization process, which was interrupted in the first 6 months of this year. So I do think that that is the baseline plan at this point. September would be a natural focal point for that, and then maybe follow that up at a subsequent meeting. But I don't think that the committee is considering sort of wholesale reductions in the policy rate, because inflation is still somewhat above the target, and they want to see the effects of tariffs.
Beneath the headline, Jim, as you know, in the details, it's very much good versus services at the moment. How concerned are you by what's developing in services?
I still think that the overall inflation rate is going to continue to either stay where it is or decline slightly. And I think that's pretty good policy. I think you want to bring the inflation rate back to 2%, but not too fast. And I think they've got about the right policy to do that. But they do have some room to lower the policy rate. And I think you'll see that in the second half of the year.
Jim, you've been on the committee. You've got plenty of experience also of the pressure coming from the White House at the same time. The pressure coming from the White House in the president's second term is much higher, much more powerful, stronger than we saw in the first term. When you're on the committee and you hear these kind of threats, does it change the way you go about your business in any way, shape or form?
No, it doesn't, except that what's happening is that this will induce inflation risk premium in the 10-year. And so you'll get higher 10-year yields than you would otherwise have if this wasn't going on. And then the committee has to take that into account. I don't know why you want to whip up an inflation risk premium, but obviously investors want to be careful. How much inflation is the new administration willing to tolerate going forward? And that's the thing that the bond investors have to price in. So unfortunately, this is going in the wrong direction. That's also going to push up financing costs for the government. That depends on the weighted average maturity of the Treasury debt, and some of that's longer term. So some of that is going to be influenced also by the inflation risk premium that will now start to develop. So unfortunately, this is going a little bit in the wrong direction, I think, from probably where the administration really wants to go.
That's the market impact. When it comes to the political theater of this all, J.P. Morgan's equity derivatives team is out with a note saying what's currently unfolding before our eyes has been happening for decades behind closed doors. Is this idea of Fed independence a myth?
We've talked about it before, but I don't use the phrase, or try not to use the phrase Fed independence. I would say it's designed to be arm's length from politics, which would mean that the Fed chair is not a cabinet position like the Treasury Secretary that you get to appoint as soon as you take office. But you do get to appoint the Fed chair about 1 year into a new term, and that's to give a little bit of political insulation, and so that things aren't moving quite so rapidly and are smoothed out a little bit. Otherwise, you would have a lot of back and forth as administrations come and go with monetary policy, and that would be probably counterproductive. Again, you'd get a lot of uncertainty in markets that would have to be priced in. You get a higher level of rates that would be unnecessary. So I think arm's length from politics is the way to think about this. I mean, you do have political appointees at the Fed, so obviously there's a political element to it, but it's designed to smooth out the ups and downs compared to what you would get for a cabinet level position.
Jim, as you know, each leader at the Federal Reserve has a different style. There is a theory on Wall Street, which I'm sure you've heard, that if someone is nominated by this president that the rest of the committee believes is just a political puppet, the rest of the committee will gang up against them. And maybe there'll just be a chairman in name only. Can you describe the dynamic on the FOMC, whether that's conceivable from your point of view?
Yeah, you did have the example of G. William Miller during the Carter administration, and he did not have the support of the committee or Paul Volcker in particular, who is then the head of the New York Fed. The story that I remember that your viewers might appreciate is that there was no smoking in the room. There was a no smoking sign, and Volcker lit up his cigar and started smoking a cigar. So I think that shows you what can happen if you nominate somebody and have somebody come into the job that doesn't have the respect of the institution. And by law, this is all done by committee, and really a chair has to navigate the committee and win friends and influence people. So that's a key element of the Fed chair's role.
Jim, I've only got 30 seconds left, so forgive me. But Governor Waller, what's your director of research at the St. Louis Fed? What kind of Fed chair would he make?
I think he'd be very good. I think he's a very strong candidate. I don't know if he'll win this, but he's certainly got a lot of background in macroeconomics and monetary economics, but he's also been on the board for quite a while now and has a lot of sense of the Washington interface. So I think he'd probably be a good choice here.
Jim, appreciate your time, sir. As always, the former St. Louis Fed President, Jim Bullard.
Great to be here in Chicago, and thank you so much. I am here with Scott Kirby, the CEO of United Airlines, after earnings came out. And he really echoed what we heard from Delta, which was the first reporter, which is stability, solidness, a sense of recovery. You said the world is less uncertain today than it was during the first 6 months of 2025. What was the inflection point where you saw that certainty come into play?
This year, a lot of uncertainty in the first half of the year, macro uncertainty, and that led to an impact on bookings and demand at United and across the whole industry. But it felt like there was a turning point at the end of June where the tax bill passed and the situation in the Middle East was calmer, and tariffs, while not certain yet, narrowing the range. And it really felt like people felt enough confidence or enough lower level of uncertainty that they kind of came off the sidelines and were unfrozen, and particularly for business demand. I mean, you can't stay on the sidelines forever, and that was enough of a trigger. And it really was like a light switch flipped at the end of June, particularly for business demand, double-digit acceleration in business demand as we ended June, and that's continued, through yesterday.
We've talked a lot about the K-shaped recovery and the idea that high-end consumers have really been driving the economy. Corporations kind of dropped off with business travel. As you said, they picked back up. What about the rest of the travelers, the main cabin? How much have they rebounded back to where they would have been had there not been some of the headline volatility?
So if you sort of separate into those three pieces, business demand dropped off at the start of the year. That seems like it's bounced back to what we were expecting it to be as we moved into July. Premium and higher end leisure sort of stayed consistent throughout. It never really dropped off. And the biggest impact for the consumer was in low end leisure. And that's come back some in July, but not as much. I'd say that's sort of 50% recovered to what we were expecting at the start of the year. So business back to mostly a full recovery, and low end leisure kind of 50% recover. Premium leisure never fell off.
We've seen sort of one entrant into the CPI report. The idea of inflation has been airline tickets prices have been coming down. And there's this question of whether discounting is required to bring some of the main cabin back, and whether that's going to be a persistent trend, that competing on price is going to be really important. Now, how much do you see that as persisting into the second half of the year?
The airline industry is always good value and always has attractive prices. But I think it's more of a supply-demand imbalance, that there are a number of airlines, there are two brand loyal airlines in the United States who are now generating the bulk of the industry's profits because those customers that care about quality, that care about service, that care about technology, we're just better, and they're choosing us. And you can see it in the data, you can see it in the numbers. For the more commoditized part of the business, there's simply more seats available. There's been more seats available than there is demand. But encouragingly, there's a big change coming in mid-August. While we've talked about demand, and I see an inflection in demand, there's also an inflection coming in supply. As by the time we get to mid-August, there are a lot of seats. Same thing happened last year. A lot of seats coming out of the industry, particularly from the low-end carriers who've been struggling. Those seats are coming out. And so my guess is that's going to lead to a firmer pricing environment as we move into mid-August and beyond. Actually, we can already see that in our numbers for later in the year.
Are you expected to take any capacity out?
We continue to prune, but there's not going to be any structural changes to our capacity. And we are encouraged by the environment. And in fact, just in the last couple of weeks, for us at least, the yields have turned positive on domestic. They've been down, for several months as we started the year, but yields have now turned positive for forward bookings at least. So
why have you not gone with the more bullish potential estimates then for your forecast, given that you sound incredibly positive and you have seen this ongoing rebound? Yeah,
it's been a good year. I mean, it's actually pretty remarkable that we've grown earnings and margins for the first half of the year despite everything that's happened. But a lot has happened this year. And we like to have a policy of being conservative on our guidance because stuff does happen. And we want to be able to absorb some unexpected events in our guidance. So we intentionally build it conservatively. We did that we do that all the time. So really what happened this time is we've been able to build that conservatism back. So, if nothing else happens this year, which is a big if, and if demand stays as strong, booking demand stays as strong as it is right now, there's probably upside. But we'd rather be conservative than get too far out over our skis.
One reason why I was really excited to speak with you is that you have a real-time view of not only the consumer and the appetite there, but also international demand, and whether there has been any damage to the brand Americana. The idea of foreign travelers coming to the United States for tourism, et cetera. You've said that there has been a drop-off in European travelers. How sustained do you expect that to be? Are you seeing any permanent shifts in that international inbound landscape?
There has been a drop-off in inbound demand. Europe is one, but it's a single-digit decline. And U.S. point of sale has more than made up for it, and it's 80% of our business. I don't think it'll be permanent. The United States is the greatest country on earth. It's a great place for people to come, a great place for people to visit. Demand is affected by all kinds of things. We have fewer students coming to the U.S. right now, not surprisingly. That's a big part.
Fewer?
Quite a bit fewer. I mean, enough. It's a relatively small percentage of the business, but when you're talking about 1%, 2%, 3% changes in demand, you can see it when you're talking about small changes. But my guess is that we will get back to normal, and people's desire to travel, see the world, whether you're an American or a European or a Canadian, is strong. This is a great place to visit, and my guess is it'll get back to normal.
And if you're a senior and you're applying to colleges right now in the U.S., you probably are in pretty good shape. That's all I can say. There's also a question about the further uncertainty, and tariffs are almost a certainty at this point. How do you expect to absorb them? Are you planning, or do you have a base case for whether you'll increase prices or whether it will just hit margins more significantly?
For United, we're fortunate that most of our aircraft come from Boeing, so here in the U.S., and even the Airbus deliveries we have are mostly produced here in the United States. So tariffs don't have as big of a direct impact on us as they do perhaps on our competitors. The bigger issue for us is the impact that it has on the macroeconomy. And, I feel really good. You were right earlier. You said we have a real-time indication of the economy. We're a very good real-time indicator of what's going on with the economy. Not always advanced, but good real-time. And it really does feel like something changed at the end of the June. The level of confidence, at least less uncertainty. People are moving forward. And I think on tariffs, there's a narrower range of outcomes. Like, probably not going to be 145% on China. There's a narrower range of outcomes, and people have had 6 months to sort of figure out how to deal with it and have some contingency planning. Whatever the reasons are, it does feel like there's more certainty.
With Boeing, do you expect the deliveries to be on time, or do you expect there to be more competition with all the other countries that are making deals to buy Boeing planes?
That'll be an interesting point of what happens with tariffs. My guess is aviation ultimately will wind up excluded. It's the one industry. U.S. exports 6 times more aviation products than we import, so we have a big trade surplus on that side. So my guess is those will wind up excluded. But Boeing, is back on track. Narrow bodies are actually ahead of schedule for us. Wide bodies are still behind. I think that's less a Boeing issue, probably more an engine issue and the supply chain for engines. I think that's a longer term, multi-year challenge to get the wide body back on track. But Boeing seems to have turned the corner on production.
I just want to finish on Newark and whether Newark's turned the corner. I do know that we could go for an hour about the delays and some of the drama around that airport. You guys have a huge presence there. You have made this partnership with JetBlue and moved to JFK. Do you expect to expand more in the tri-state area to try to diversify your presence away from Newark?
Well, first, I'm really pleased with what Secretary Duffy and the Department of Transportation and FAA have done at Newark. But my entire career here at United have been trying to get Newark on an equal footing with LaGuardia and JFK. That's essentially putting slot controls. Have the number of flights at the airport equal to the capacity of the airport. And we've finally done that. And you can already see the results. In June, Newark was the most reliable of the 3 New York area airports. And the future looks really good. So we feel really good about Newark, and it's a crown jewel, and we're going to grow it. And it's always going to be a crown jewel for United. But from the first day I got here to United, I wanted us to get back into JFK. Our goal is to be the premier flag carrier of the United States, and we need to be in JFK to do that. So the JetBlue partnership is a great way for us to have a partner who has the same sort of culture on DNA for customers to get back, and have a presence on both sides of the river.
Scott Kirby, thank you so much for taking the time today.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.